Seeking professional financial advice can involve a reasonably high fee. We've seen in the news today that 4 in 10 financial advisors who offer advice on defined benefit pension transfers have raised their fees since 2018 due to higher regulatory costs. The survey commissioned by the Financial Times found that many advisors have given up their pension transfer permissions, but 40% of those who have stayed in the market have passed on rising costs to their clients. I'm slightly salty when it comes to this subject of rising regulatory costs, because we've just had our renewal terms through for our professional indemnity insurance. Our premium has come in this year a little bit shy of £100,000, up about 40% or so on the cost that we paid last year. And another invoice has landed in my inbox today. The FCA has demanded £1,134 as a supplementary levy towards the rising cost of the Financial Services Compensation Scheme. That's on top of the £33,200 levy that we paid to fund the FSCS last year. So it's inevitable that the rising cost of delivering professional, impartial financial advice will go up. We're a business after all, and these bills have to be paid. However, there is significant value in paying for financial advice for financial planning. You just need to know the key moments in life when it can pay to pay for advice. Fund manager 7IM has shared a list of 7 key moments when it could pay to take financial advice. I'm going to take a look at those key moments in this video so you're aware of what they are. These 7 life-changing moments come from Michael Martin, who is a private client manager at 7IM. Michael says these big life moments may be an especially good time to ask a professional to help steer you through. First up is getting married or entering a civil partnership. Michael says you've tied the knot, enjoyed your honeymoon and settled down. While it's not very romantic, an important next step for couples to consider is their future finances. One of the first things you might want to look at is tax-free allowances. Are you and your partner both using all of your allowances for tax-free income, capital gains, savings and pension contributions, to name a few? Of course, tax treatments will depend on your individual circumstances and may change in the future, which is why it's so important to have someone who can guide you along the way. Seeking professional help to advise you on moving assets between partners could considerably reduce your combined tax bill each year and therefore be well worth it. Now, getting married, and I've done this twice in my life to date, it's a growing up moment. All of a sudden, you've got financial responsibilities, not just for yourself, but for someone else too. You're bringing together 2 financial worlds into one. And while it's not particularly romantic to talk about money or even longer term plans like your retirement plans, it is important. If you and your significant other can both get together on the same page, you can make much better progress towards your shared financial goals in life. And working with a third-party professional advisor can make that conversation just a little bit less awkward. In fact, your financial advisor can act as a mediator, especially when the two of you have got slightly different attitudes and experiences of money, helping you to bring those goals together so you're both working to pull in the same direction. Number 2 is getting a divorce. Michael said the average age of divorce has risen to the mid-40s, around 6 years higher than it was 20 years ago. And that means it's more likely those couples divorcing have collated more assets between them. A divorce agreement can involve many complex processes, particularly with estates, pensions and investments. All these processes must be perfectly timed to avoid the possibility that either party loses out. Some assets may need to be sold and some others earmarked. This should all be done as tax efficiently as possible. Getting a divorce is something I've only done once in my life, hoping never to do again, but I've got some experience here as well. Divorces are a sad fact for many marriages and also dissolutions, of course, of civil partnerships. There is a good way of doing divorce and there's also a bad way of doing it. Divorce can have a significant impact on your financial life, so making the best possible decisions with your money, and that includes your pensions and your property, can ease this particular transition in your life. This is one key life event where you want to avoid making very expensive mistakes that will have long-lasting implications. Number 3, invest in your children's future. Michael said, children focus your mind firmly on the future. An advisor can help you prepare for their future, whether it is covering education costs or taking that first step onto the eye-wateringly expensive housing ladder. Plus, children can be exhausting, so take any opportunity to delegate. Choosing between a junior ISA and a junior self-invested personal pension can be difficult, as each has its merits and pitfalls. A professional financial planner will be able to look at your individual circumstances and advise what's best for you. I'm responsible for 3 children, so I've got some experience when it comes to this one. So children are bloody expensive. expensive. There's no escaping that fact. The earlier you start saving and investing for your children, the better. Time is an incredibly powerful way to build more money for the future. This is what Albert Einstein allegedly referred to as the eighth wonder of the world: compound returns, compound interest. It basically means money earned on money earned on money. You don't know when your children are born whether or not they're going to end up going to university, or what the situation might be when they become young adults. But whatever they choose to do, there's likely to be a significant cost involved. Saving money for their future, investing money for their future, can give them the best possible financial start in life. It might help pay for their university education, it might help them to get a foot on that expensive property ladder, or even start their own business. You don't need to know what the money is for specifically to start saving, start investing for their future. Sitting down with a financial advisor can help you incorporate that plan for saving for your children's future within your wider financial plan. Number 4 from Michael: receiving a windfall, inheriting money. He said receiving a sum of money can transform your financial outlook, but then the pressure's on to make the most of it, and deciding what to do can be daunting. This is where an advisor can prove invaluable. In a low rate climate, it can be tricky to choose between company shares, managed funds, investment trusts, bonds, property funds, or bricks and mortar. And what about the options you haven't even thought of? Having a large lump sum to invest could give you access to vehicles you've not been able to invest in before, such as enterprise investment schemes and venture capital trusts. These offer generous tax breaks to those prepared to take more risk. If you're unsure about the risk you want to take, or unsure whether this is a suitable approach for you, an advisor could also help determine this and help you build a suitable investment portfolio. Having a big lump sum of money ending up in your bank account for whatever reason, that might be an inheritance, it might be the sale of your business, it might even be a lottery win, although that is of course incredibly unlikely. It's a life-changing event regardless, and you should absolutely seek professional advice at this stage in your life if this happens to you, especially if you don't have experience of dealing with large sums of money. The temptation is there to spend it, to fritter it away on unnecessary things. It's far easier to spend money than it is to make money. So this is an opportunity to sit down with a professional advisor and understand how that money can genuinely change your life for the better, how it can bring you closer to achieving your financial goals in life. Number 5, retiring. Michael said, with the pension freedoms, you now have far more choice over what to do with your pension pot once you've reached 55. However, with more choice comes more complexity. You now need to consider whether to take out a lump sum up front, and if so, how much. You could also think about buying an annuity, which guarantees you an income for life, or you could invest in other income generating products, giving you more flexibility. Another major consideration is how much money do you need? Unless you have a crystal ball, a spot of financial planning could help with that too, forecasting what you might need, whatever your financial future may hold. Not fully retiring is another option. After all, going from working 50 to 60 hours a week to doing very little with your time could be quite a shock to your lifestyle. So working part-time can be appealing. However, working while drawing on your investments could create some complicated tax implications. A financial advisor is well equipped to analyse your situation, help plan your approach, and advise on your tax position and on suitable tax wrappers. Retirement is the area where I would suggest we see the majority of client inquiries. I think that's because the financial advice profession is very well established, very well created to help people make choices and options about their retirement income. You've likely reached the retirement stage in life having accumulated significant assets within your investment portfolio, within your pension pot, and you need to make decisions that put you on the best possible course for the future. Since the introduction of pension freedoms back in April 2015, a growing number of people have started using flexible income drawdown to generate a retirement income. Doing this involves greater complexity than the old preferred approach, which was to take your pension pot and buy a financial instrument called an annuity that guaranteed an income for the rest of your life. With flexible income drawdown, you leave the pension pot invested, you take a variable withdrawal from that pension pot, and invariably there are more decisions to make. While you may be very capable of making those complicated decisions when you start taking your retirement income, say in your mid-60s or your early 70s, neuroscience tells us that as we age, our ability to make complex decisions deteriorates. And at the same time, our confidence in making those financial decisions remains the same. And that's a very dangerous place in which to be, which makes working with a financial advisor in your retirement incredibly valuable, so they can help you avoid making expensive mistakes. And they can bring to bear all of their experience, all of their expertise when it comes to suitable investment strategies and a suitable and sustainable withdrawal rate from your pension pot. And of course, all other aspects of retirement planning too, which make the difference between a successful and an unsuccessful retirement. Number 6, passing wealth on. Michael said rising house prices have pushed more people than ever before into the dreaded inheritance tax net. Current HMRC stats show that £5.2 billion was paid to the Treasury in inheritance tax in the 2019-2020 tax year. Nobody wants to leave their loved ones with a huge bill. With careful planning and some financial advice, you can reduce the impact of this hefty 40% tax. Giving money away at least 7 years before you die is one way, and there are various types of trusts that you can set up for future generations. It's also important to think about your will. Whilst clearly not the most cheery of subjects, making sure your will is done by a qualified advisor or solicitor and is up to date will ensure that everything will be quicker and easier to sort out after you're gone. Estate and tax planning can be complicated and the rules change often, so it's well worth getting advice. This is another one where we see an awful lot of client inquiries, and I used to call it estate planning until I was corrected by a client who said to me, well, I don't have an estate, so inheritance tax planning is probably a better expression for it. In my experience, people tend to be fairly polarised when it comes to their inheritance tax planning. They either want to do everything in their power to minimise the amount of tax paid to HMRC, or they take the view that their children are still going to inherit more money after paying inheritance tax, more than they ever received in their lives, and therefore they don't want to give up control of their assets for effective tax planning. All inheritance tax planning is a balance between effectiveness and control. What I mean by that is that you can reduce or entirely remove an inheritance tax bill by giving away your money, by losing control of your assets. But it's unlikely that you're going to want to do that or even find yourself in a financial position where it's possible. So inheritance tax planning comes down to striking that right balance between effectiveness and control, how much tax you want to save, and how much control of your money you want to retain. And then number 7, stay flexible. Michael says, while having a clear financial plan in place is the best way to arm yourself to secure a robust financial future, it's also important that those financial plans are flexible and that you don't leave yourself dependent on one outcome. Diversifying your risk, be that tax or investment, and having a mix of both short and long-term savings should allow you to weather any storms and keep your financial plans on track. Having the proper advice to implement this flexibility to cover unforeseen costs or market downturns can still allow you to protect your finances and achieve the lifestyle you want. This last one is really about risk management, and that's such a key part of what we do as financial planners. You would have heard me before in these videos talk about the importance of diversification. That's not just about spreading around your investment portfolio across different asset types, but it's also things like diversification of income. We've all heard that expression, haven't we? Don't place all of your eggs in one basket. When we construct financial plans for our clients, we consider a range of different catastrophes which may or may not occur in your life. By modelling these catastrophes and understanding these risks, we can graphically illustrate the impact they might have on your long-term financial planning, on your long-term cash flow forecast. Simply the act of seeing the impact of a catastrophe on your financial plan up on the big screen can give you some reassurance. It can offer you some peace of mind. Peace of mind that should the worst happen, should something big happen in your life that tries to derail your financial plan, you'll be okay. Because part of the financial planning process is putting in place protection should the worst happen. That creates the financial resources you need for you or for your family to see you through to the other side of that disaster. So 7 key moments there where it can pay to take financial advice. As I said right at the top of the video, I know that financial advice can seem expensive, and sadly we're working today in a regulatory environment where costs are only going in one direction, and they're going in that direction rather rapidly at the moment. But there is a big value associated with professional financial advice. There's a big difference between the cost of advice and the value of advice. Smart clients, smart investors, they focus on value, not on price, and it's our job as financial planners to articulate that value, to help our clients understand how much value there is in what we do for them. Are we following each other on Twitter yet? You can find me there at Martin Bamford. It's the place I tend to hang out online the most. Let's start a conversation over on Twitter at Martin Bamford. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.